This video is for anyone preparing to pass the Illinois state portion of the Life Insurance Producer exam. It covers only what is specific to Illinois, the state laws, the regulations, the figures, and the deadlines that Illinois does differently from the national rules you are studying elsewhere. We are assuming you already have a separate course for the national material, the general concepts of life insurance, policy types, underwriting, and federal law. We will not reteach those here. What we will do is hand you the Illinois layer, the part that trips people up, the part the state test is built on. Here is the thing to understand about your exam. You will sit for two separate tests, a general test and an Illinois state test, and you have to pass both. The state test is short but dense. It gives you 31 scored questions, plus a handful of unscored pretest questions mixed in, and you get 50 minutes. That is roughly a minute and a half per question, and every one of those questions is about Illinois. So the numbers in this video are not trivia. They are the test. When we tell you a figure, we are going to repeat it, because repetition is how these numbers move from something you heard into something you know cold. Let's get to work. We'll start with who runs insurance in Illinois, because every rule we cover after that flows from that one office. Illinois regulates insurance through the Illinois Department of Insurance. Notice the title of the person in charge, because the exam likes to test it. In Illinois, the regulator is called the director, not the commissioner and not the superintendent. Many states use commissioner, so if you studied national material, you may have that word stuck in your head. Set it aside. In Illinois, it is the director of insurance, and on your exam, when a question describes the official who runs the department, the answer is the director. What does the director actually do? The director enforces the Illinois Insurance Code, issues and revokes licenses, writes the administrative rules that fill in the details of the statutes, and investigates companies and producers. One of the director's core powers is examination. The director can examine the books and affairs of any insurer doing business in Illinois to make sure it is solvent and following the law, and the director can examine producers as well. Think of examination as the director's audit power. It is how the state keeps companies honest before a problem becomes an insolvency. The director also has the power to penalize. When a producer or a company breaks the rules, the director can act, and the law gives a specific ceiling on money penalties that the exam may ask about. The director can assess a civil penalty of up to $10,000 for each violation, and the total for all violations in a single action cannot exceed $100,000. We'll say those again because they are a favorite trap. It is up to $10,000 per cause and no more than $100,000 in total. If you see those two numbers swapped or inflated in an answer choice, be suspicious. Let's recap this short section. The regulator is the Department of Insurance. The official in charge is the director. The director's audit power is called examination. And the money penalty caps are $10,000 per violation and $100,000 total. Lock those in. Next, we move to the part of the law you will live inside as a producer, getting and keeping your license. Studying for your insurance licensing exam? Check out the My Insurance Guide flashcards app, built specifically to help you pass your insurance licensing exam with confidence. Master over 1,000 expertly curated flashcards across every insurance line. Built-in spaced repetition brings back the tough terms right when you need them, and timed practice exams prepare you for the real thing. Click the link below and download today. Now, back to the video. Let's walk the path to your license in order, because the exam tests the sequence and the numbers along the way. First comes prelicensing education. Before you are allowed to even sit for the exam, Illinois requires you to complete 20 hours of approved prelicensing education for the Lifeline. Of those 20 hours, 7.5 must be completed in a classroom or live webinar setting, meaning a real instructor in real time, not pure self-study. We'll repeat that split because it is exactly the kind of detail the test loves. 20 hours total, 7.5 of them live. When you finish, you receive a certificate of completion, and that certificate is good for 1 year. You must pass your exam and get licensed within that year, or the prelicensing expires, and you have to take the whole course again. Next, you take the exam, which we will cover in full at the end of this video. After you pass, there is a waiting period that surprises people. You cannot apply for your license immediately. Illinois makes you wait 5 days after passing the exam before you submit your license application, and you apply through the National Producer Registry online. 5 days. If a question asks how soon after passing you can apply, the answer is not the same day and not the next day. It is after 5 days. Now, who needs a license in the first place? Anyone who sells, solicits, or negotiates insurance in Illinois must be licensed. Those 3 verbs matter: selling, soliciting, or negotiating. Any one of them requires a license. A purely clerical employee who takes down a phone number but gives no advice and earns no commission on the sale is not selling, soliciting, or negotiating, and does not need a producer license. Illinois also licenses producers from other states. A non-resident can get an Illinois license without retaking prelicensing or the exam if they hold a license in good standing in their home state through reciprocity. And here is a related rule for people moving to Illinois. If you were licensed for the same lines in another state and you move here, you are not required to complete Illinois prelicensing or the exam as long as you apply within 90 days of your old license canceling and your prior state sends a letter of clearance confirming you were in good standing. On your exam, that window is 90 days. Miss it, and you are treated like a brand new applicant. Finally, temporary licenses. Illinois can issue a temporary producer license so that an insurance business does not collapse when something happens to the producer running it. The classic case is the death or disability of a licensed producer, where a surviving spouse or a personal representative needs time to sell or run the business. That temporary license can last up to 180 days, and the director may renew it for one additional 180-day period with no exam required. Say that with us: 180 days, renewable once for another 180. There is also a separate temporary license available to a new applicant who is enrolled in a training program, and that one runs for 90 days. Let's recap the numbers you must memorize from this section. Prelicensing is 20 hours with 7.5 live. The certificate lasts 1 year. You wait 5 days after passing to apply. A new resident from another state has a 90-day window. A temporary business license runs 180 days and renews once. Mix those up, and you will lose points. Next, we keep that license alive, and look at how you can lose it. Your Illinois producer license is not permanent, and it is not annual either. It runs on a 2-year cycle, and before each renewal, you have continuing education to complete. Continuing education, or CE, is ongoing coursework that keeps your knowledge current. Illinois requires 24 hours of CE before each license renewal. Of those 24 hours, 3 must be ethics, completed in a classroom or webinar format. We'll repeat that, because the ethics piece is a classic test point, 24 hours total, and 3 of them ethics. The ethics requirement is not satisfied by self-study reading alone. It is a live or webinar requirement. While your license is active, you carry reporting duties, and the deadlines are tested. If you are convicted of a felony while licensed, you must report that conviction to the director within 30 days of the judgment, and you must send along the court documents. 30 days. You also report administrative actions taken against you by other states or regulators. The theme here is that Illinois wants to hear about trouble from you promptly, not discover it later. There is a related rule on the company side that the exam blurs with appointments, so let's be clear about how Illinois handles this. Many states require an insurer to formally appoint a producer before that producer can write business for the company, and to pay an appointment fee. Illinois is different. For the major lines like life, Illinois does not require that traditional appointment. Instead, the company keeps its own record of the producers it has authorized and provides that list to the director on request. What Illinois does require is notice when a relationship ends for cause. When an insurer terminates a producer for one of the serious reasons the law lists, the insurer must notify the director within 30 days of the termination, and must mail a copy of that notice to the producer within 15 days. The producer then has 30 days to file written comments. Notice that 2 of those windows are 30 days, and 1 is 15. Keep them straight. Now, losing your license. The director can place a producer on probation, suspend the license, revoke it, refuse to issue or renew it, or levy a fine for a list of causes. Those causes include giving false information on your application, violating any insurance law or order of the director, obtaining a license by fraud, misappropriating money that belongs to clients or companies, intentionally misrepresenting a policy, and being convicted of a felony. That last one is not automatic. A felony conviction is a cause for action, but the director weighs whether you have shown enough rehabilitation to be trusted with the public's money. If the director moves against your license, you have a right to fight it, and there is a deadline. You may request a hearing within 30 days of the date the director's order is mailed to you. 30 days, in writing. Miss that window, and you lose the chance to contest it. Let's recap. Your license is a 2-year license. CE is 24 hours per cycle, with 3 ethics hours done live or by webinar. You report a felony within 30 days. An insurer reports a for-cause termination to the director within 30 days. And you demand a hearing within 30 days of the director's order. A lot of 30-day windows live in this section, so when a question gives you a deadline tied to license trouble, 30 days is very often the answer. Next, we turn from your license to your conduct, the duties you owe the people whose money you handle. The moment you collect a premium from a client, you are holding money that is not yours. Illinois treats that money as held in a fiduciary capacity. A fiduciary is someone trusted to handle another person's money or property in that person's interest, not their own. As a producer, premiums you collect on behalf of an insurer must be accounted for and paid over promptly. You cannot mix that money into your personal accounts and treat it as yours, and you cannot sit on it. Commingling client and company premium money with your own funds and then using it is one of the fastest ways to lose a license. On your exam, when you see a producer depositing client premiums into a personal account and spending them, the word the test wants is a breach of fiduciary duty. Commissions follow the license. Illinois law lets an insurer pay a commission only to a person who holds the proper license for that business. The flip side is that an unlicensed person cannot be paid a commission for selling, soliciting, or negotiating insurance, and you cannot pay one to them. This is how the state keeps unlicensed people out of the sales process. There is a narrow exception that lets a licensed producer share commissions with another licensed producer. But the core rule is simple: no license, no commission. Disclosure rounds out your duties. If you are going to charge a client a fee on top of, or instead of, commission, Illinois requires that arrangement to be disclosed to the client in writing before the service. The principle is transparency. The client should never be surprised by what you are being paid or what you are charging. Let's recap this section in one pass. Premiums you collect are held as a fiduciary and must be paid over promptly, never commingled and spent. Commissions can be paid only to the properly licensed. Fee arrangements must be disclosed in writing up front. Those 3 ideas, trust, licensing, transparency, sit underneath every conduct rule we cover next. Speaking of which, let's go to the prohibited practices, the section the marketing questions come from. This is one of the more heavily tested areas, so let's go through the prohibited practices one at a time, define each one plainly, and flag where the exam tries to trip you. These are the unfair trade practices Illinois bans, and the test loves to give you a scenario and ask you to name the violation. Start with rebating. Rebating is giving a customer something of value that is not stated in the policy as an inducement to buy, a kickback in plain terms. If you offer to hand back part of your commission or give a gift card or pay the first premium yourself to close a sale, that is rebating, and Illinois prohibits it. Here is the trap. Rebating is illegal even if the customer asks for it, and even if you would offer the same rebate to everyone. The customer wanting it does not make it legal. Next, misrepresentation. Misrepresentation is making a false or misleading statement about a policy's terms, benefits, or an insurer's financial condition. Telling a client a policy has a benefit it does not have, or that the cash value is guaranteed when it is not, is misrepresentation. A close cousin is twisting. Twisting is misrepresentation used specifically to convince a policyholder to drop one policy and replace it with another, to the policyholder's disadvantage. Let's be clear about the difference, because the exam pairs them. Misrepresentation is the false statement. Twisting is misrepresentation aimed at churning a replacement. If the scenario involves convincing someone to switch policies using a misleading comparison, the answer is twisting. Then, defamation. Defamation in insurance is making a false statement that damages the reputation of an insurer. For example, spreading a rumor that a competing company is about to go broke when it is not. Notice the direction. Defamation runs against a company's reputation. Don't confuse it with misrepresentation, which is about the policy. Beyond those named practices, Illinois bans a broader category of unfair methods of competition and deceptive acts, which is the catch-all the director uses for conduct that does not fit a neat label but still cheats consumers or competitors. Unfair discrimination belongs here too. Charging different premiums or offering different terms to people of the same class and same risk is prohibited. Let's recap the prohibited acts you must be able to name on site. Rebating is the kickback, illegal even when requested. Misrepresentation is the false statement about a policy. Twisting is misrepresentation used to push a replacement. Defamation is the false statement that harms a company's reputation. And unfair discrimination is treating equal risks unequally. Memorize the definitions, because the questions are almost always scenarios that want the label. Next, we look at one specific kind of misconduct that gets its own rules, how claims must be handled. Illinois has a specific regulation governing how insurers must handle claims, and it sets deadlines that the exam can ask about directly. The point of these rules is to stop companies from delaying and stonewalling people who have valid claims. While these rules bind the company more than the individual producer, you are expected to know the time frames. Start with acknowledgement. When a company receives a communication about a claim, it must respond with reasonable promptness, and Illinois defines that as a maximum of 15 working days. Working days, not calendar days, and that distinction matters because the exam may test it. 15 working days to acknowledge. Then, investigation and decision. The company must conduct a prompt investigation and must affirm or deny liability on a claim within a reasonable time. Once it affirms liability and the amount is settled and not in dispute, it must offer payment within 30 days. So the rhythm is acknowledge within 15 working days, investigate promptly, and pay an undisputed, affirmed claim within 30 days. If the company cannot reach a decision and the claim drags on, it cannot simply go silent. It must send the claimant a written explanation of why the claim is still being delayed. The principle the exam wants you to grasp is that silence and indefinite delay are themselves violations. Knowingly misrepresenting policy provisions to a claimant, failing to acknowledge claim communications promptly, and forcing a claimant to sue by refusing to pay clear claims are all listed as improper claims practices. On your exam, if a scenario shows an insurer ignoring a policyholder's letters or refusing to explain a long delay, the answer points to a violation of the Unfair Claims Practices rules. Let's lock the two numbers from this section because they are the testable ones. Acknowledge a claim within 15 working days. Pay an undisputed, affirmed claim within 30 days. Next, we move into the heart of the life-only material, the policy provisions Illinois requires in every life contract. Every individual life insurance policy sold in Illinois must contain a set of standard provisions, and these are some of the most heavily tested figures on the entire state exam. We are going to state each number, repeat it, And where Illinois differs from what you might expect, we'll say so. Take these slowly. Start with the grace period. The grace period is the window after a premium due date during which the policy stays in force even though you have not paid. Illinois requires a grace period of 30 days or 1 month on a life policy. During that grace period, the coverage continues, and if the insured dies during it, the company pays the death benefit but may subtract the overdue premium. 30 days. We'll say it again. The Illinois life grace period is 30 days. Next, the free look. The free look is your right to return a newly delivered policy for a full refund if you change your mind. In Illinois, the free look on a life policy is a minimum of 10 days from the day the policy is delivered to you. 10 days to read it, think it over, and back out with all your premium returned and no penalty. Hold on to that 10-day figure because there is a twist coming when we reach replacement, where the window grows. Now, incontestability. The incontestability clause says that after a policy has been in force for a set period during the insured's lifetime, the company can no longer contest it or deny a claim based on a misstatement in the application, except for not paying premiums. In Illinois, that period is a maximum of 2 years. After 2 years, the company is locked in. Here is the Illinois nuance the exam can probe. The contestable period can be written to run from the policy's date of issue. So once you pass that 2-year mark measured from issue, even an honest mistake or a misstatement on the application can no longer be used to void the policy. 2 years. On your exam, if a death occurs and the company discovers an application error, the question is almost always whether the policy was still inside that 2-year contestable window. Reinstatement comes next. Reinstatement is putting a lapsed policy back in force after you failed to pay and the grace period ran out. Illinois lets you reinstate within 3 years of the default, provided you show evidence of insurability satisfactory to the company and pay the back premiums with interest. Notice the contrast that the test exploits. The incontestable period is 2 years, but the reinstatement window is 3 years. 2 and 3. The exam loves to swap those, so if you see reinstatement paired with 2 years, be suspicious. It is 3 years. A few more provisions worth knowing. The entire contract provision means the policy and the attached application together make up the whole agreement, and the company cannot rely on outside documents. The suicide exclusion lets the company deny a death claim and refund premiums if the insured dies by suicide within the first 2 years, another 2-year figure, so be careful not to confuse it with incontestability, even though they share the number. Misstatement of age or gender does not void the policy. Instead, the death benefit is adjusted to whatever the premium actually paid would have purchased at the correct age. And when a valid death claim is filed, Illinois expects prompt payment. If the company does not pay the death benefit within 30 days, it owes interest on the proceeds. Let's recap the must-memorize numbers, because this is the densest section in the video. Grace period, 30 days. Free look, 10 days minimum. Incontestability, 2 years. Suicide exclusion, 2 years. Reinstatement, 3 years. Death benefit interest if unpaid after 30 days. Say them in that order a few times until the 2s and the 3s stop blurring together. Next, we look at how these policies are allowed to be sold and what you must hand the buyer. Illinois regulates not just what a life policy contains, but how it is sold and what information the buyer must receive. The goal of all of these rules is the same. A consumer should be able to understand and compare what they are buying before they commit. Start with advertising. Illinois rules on the advertising of life insurance require that any advertisement be truthful and not misleading, in fact, and by implication. That covers more than outright lies. An ad that creates a false impression by leaving out a key limitation can violate the rule even if every sentence is literally true. The principle is that the overall impression must be honest. Now, the disclosure documents, which are squarely tested. Illinois has a life insurance solicitation rule that requires 2 key documents to reach the buyer. The first is the buyer's guide. The buyer's guide is a standardized booklet that explains, in plain language, how life insurance works and how to compare policies. and its wording is set by the state, so it is the same generic guide from every company. The second is the policy summary, which is specific to the actual policy being sold and lays out its premiums, benefits, and values. The timing is the testable part, so let's be precise. For an agent-sold policy, the insurer must give the applicant the buyer's guide no later than the point of accepting the initial premium. In other words, the buyer should have that guide in hand before their money is taken. The policy summary must be delivered with the policy or before it. On your exam, if a question asks when the buyer's guide must be provided in an ordinary agent sale, the answer anchors to no later than when the initial premium is accepted. There is also a rule on illustrations. An illustration is a presentation showing how a policy's values might perform over time, often with guaranteed and non-guaranteed columns. Illinois regulates illustrations so they cannot mislead. A non-guaranteed value must be clearly labeled as not guaranteed, so a buyer never mistakes a projection for a promise. The producer cannot present an illustration as if the rosy non-guaranteed numbers are certain. Let's recap. Advertising must be truthful and not misleading, even by implication. The buyer gets a standardized buyer's guide no later than when the initial premium is taken, and a policy-specific policy summary with or before the policy. Illustrations must clearly separate what is guaranteed from what is not. Next, we look at the special rules that kick in when a new policy is replacing one the customer already owns. Replacement is when a new life insurance policy or annuity is bought, and as a result, an existing policy is dropped, lapsed, surrendered, or borrowed against. Illinois pays close attention to replacement because it is ripe for abuse. A producer churning customers out of good policies into new ones just to earn a fresh commission. The replacement rules exist to slow that down and make sure the customer is making an informed choice in their own interest. When you are involved in a transaction that you know or should know will replace existing coverage, you take on specific duties. You must find out whether the sale will involve a replacement, and you must give the applicant the required notice about replacement so they understand what they are giving up. The replacing insurer then has to notify the existing company that its policy may be replaced. Under the Illinois rule, that notice goes to the existing insurer within 3 working days of receiving the application. The reason for that step is fairness. It gives the existing company a chance to contact its customer and present the case for keeping the old policy. The company must also keep records of these replacement notices for several years. Here is where an earlier number changes, and the exam knows it. We told you the ordinary free look on a life policy is 10 days. When the policy is a replacement, Illinois extends the buyer's right to return it. The free look on a replacement policy is 20 days. 20 days, double the standard window, because the state wants to give someone who just swapped coverage extra time to reconsider and unwind the deal. On your exam, if the scenario involves replacing an existing policy and asks how long the buyer has to return the new one, the answer is 20 days, not 10. There are a few transactions that are exempt from the replacement rules because they are not the kind of churning the rule targets. As one example, the requirements do not apply when the existing coverage being affected is tiny, specifically when the total cash surrender value of all the affected policies is under $500, and their combined face amount is under $5,000. Small policies like that fall outside the full replacement procedure. Let's recap. Replacement is dropping old coverage to fund new coverage. You must identify it and deliver the replacement notice, and the replacing insurer notifies the existing company within 3 working days. The free look doubles from 10 days to 20 days on a replacement. Those 2 numbers, 3 working days and 20 days, are the ones to carry out of this section. Next, we turn to a product with its own consumer protection standard, annuities. Annuities get special treatment in Illinois because they are complex, often sold to older buyers, and easy to misuse. If you sell annuities, you operate under a heightened standard of conduct, and the exam expects you to know it by name. That standard is the best interest standard. When you recommend an annuity to a consumer, Illinois requires you to act in the best interest of that consumer at the time of the recommendation, without placing your own financial interest ahead of theirs. This is stronger than simply checking that a product is suitable. Best interest means you have to satisfy several obligations together. You must exercise reasonable care to understand the product and match it to the customer's financial situation and needs. You must disclose your role and how you are compensated. You must identify and avoid or manage any conflict of interest, such as a sales incentive that might tempt you. And you must document the basis for your recommendation. Care, disclosure, conflict of interest, and documentation. Those are the 4 pillars the best interest standard rests on. To make sure producers actually understand annuities before they sell them, Illinois requires annuity-specific training. Before you can sell annuity products, you must complete a one-time training course of 4 hours approved by the department. Say that with us. A one-time, 4-hour annuity training course. It is separate from your regular continuing education, although it can also count toward your CE. It is one time, not a course you repeat every renewal. There is also a disclosure piece. When you make an annuity recommendation, you provide the consumer a standardized disclosure describing your role in the transaction and how you are paid, so the relationship is transparent before they sign. Let's recap. Annuity recommendations are governed by the best interest standard, built on care, disclosure, conflict of interest management, and documentation. Selling annuities requires a one-time 4-hour training course. On your exam, if a question asks the standard for recommending an annuity in Illinois, the answer is best interest. And if it asks about the training, the answer is one time and 4 hours. Next, we cover 3 related ways a life policy can pay out early or be sold off. There are situations where the value of a life insurance policy gets to the insured before death, and Illinois regulates each of them. Let's define the 3 you need to know and keep them distinct, because they sound similar and the exam exploits that. First, accelerated death benefits. An accelerated death benefit lets the insured collect part of their own policy's death benefit early, directly from the insurer, when they meet a triggering condition such as a terminal or chronic illness. The money comes out of the existing policy, paid by the company that issued it, and it reduces the death benefit that the beneficiary will eventually receive. Illinois allows these benefits and regulates how they are disclosed, so the insured understands the trade-off. Second, viatical settlements, also discussed as life settlements. A viatical settlement is different because it involves selling the policy to a third party, not collecting from the insurer. The policy owner sells the policy to a viatical settlement provider for a lump sum that is less than the death benefit but more than the cash value, and the buyer becomes the owner and beneficiary and collects when the insured dies. Illinois licenses this business under its Viatical Settlements Act. The buyer is the viatical settlement provider, who must be licensed and applies annually. The person who arranges the sale on behalf of the policy owner is the viatical settlement broker, and here is the rule that gets tested. To act as a viatical settlement broker, you must hold an insurance producer license with a lifeline of authority, and you must have held that license for at least 1 year, plus complete the required broker training. 1 year of life licensure is the threshold. There is a narrow exemption. An attorney, a certified public accountant, or an accredited financial planner who represents the policy owner and is not paid by the provider may negotiate the settlement without a separate broker license. Keep accelerated benefits and viatical settlements straight with one question. Who pays? If the insured collects early from the insurer, that is an accelerated death benefit. If the policy is sold to an outside buyer for cash, that is a viatical or life settlement. Same goal of getting value out before death, completely different mechanism. Let's recap. Accelerated benefits come from the insurer and reduce the death benefit. A viatical settlement is a sale of the policy to a licensed provider, arranged by a broker who needs a life license held for at least 1 year. On your exam, the who pays question separates the two. Next, the safety net behind all of this. What happens if the insurance company itself fails? Insurance companies can fail, and Illinois has a backstop for when they do. It is called the Illinois Life and Health Insurance Guaranty Association, and it is one of the most reliably tested topics on the state exam because it comes down to specific dollar limits. Let's get them exactly right. The Guaranty Association is a nonprofit made up of all the life and health insurers licensed in Illinois. When a member company becomes insolvent and is ordered into liquidation, the association steps in to protect Illinois policyholders within limits by paying covered claims or continuing coverage. It funds this by assessing the other member companies. The protection is real but capped, and the caps are the test material. Here are the figures. For life insurance, the association covers up to $300,000 in death benefits on any one life, no matter how many policies that person held with the failed company. We'll repeat that, $300,000 in death benefits per life. For the cash value side of life insurance, it covers up to $100,000 in net cash surrender or withdrawal value. For annuities, the association covers up to $250,000 in the present value of annuity benefits per annuitant. Let's say those three together, because they are the heart of the section. $300,000 for life death benefits, $100,000 for life cash value, $250,000 for annuities. There is also an overall ceiling, regardless of how many policies or how many types of coverage a single person holds with the failed company. Their total protection is generally capped at $300,000. Now, the one rule about the association that is not a number but is heavily tested. You are prohibited from using the existence of the Guaranty Association in your sales pitch. You cannot tell a prospect that it is safe to buy from a shaky company because the Guaranty Association will cover them anyway. Advertising or selling on the strength of Guaranty Association protection is illegal because it would encourage people to ignore an insurer's financial health. On your exam, if a producer reassures a hesitant client by pointing to the guarantee fund as a selling point, that is a violation. Let's recap the numbers one more time, because mixing them up is the easiest way to lose these questions. Life death benefit, $300,000. Life cash value, $100,000. Annuity present value, $250,000. And you may never use the association to make a sale. Next, the final section, exactly what test day looks like. Let's close by walking through the mechanics of the exam itself, because knowing the structure removes a surprising amount of test day anxiety, and several of these details show up as questions. Your exam is administered by Pearson VUE, the testing vendor Illinois uses. To become a licensed life producer, you take 2 exams, a general exam, and an Illinois state exam, and you must pass both within a 90-day period. The state life exam gives you 31 scored questions, with a few unscored pretest questions blended in that do not count, and you have 50 minutes. The general life exam is longer, with 50 scored questions and 85 minutes. Your score is reported on a scale, and the passing score is 70. Understand what that 70 means. It is a scaled score, not a raw percentage of questions right, so do not read it as exactly 70% correct. 70 is the line. Above it you pass, below it you do not. On the money side, each exam carries a fee of $92, and that fee already includes the $50 state administrative charge. When you schedule the general and the state exam for the same line together on the same order, Illinois applies a discount, so you are effectively paying that $92 once for the pair, rather than twice. Separate from the testing fee, the state charges a $50 application fee to process your request to take the exam. And remember the license fee itself that we covered earlier. $215 for a resident producer license, good for 2 years. Test day has rules worth knowing. You schedule your appointment at least 24 hours in advance, and if you need to cancel or reschedule without penalty, you do that at least 48 hours ahead. You report to the test center 30 minutes before your appointment to check in. You bring 2 forms of identification, the primary one government-issued with your photo and signature, and the names must match your registration exactly. Personal items, phones, and notes are not allowed in the testing room. The exam is given in person at a test center, and it is also available in Spanish. If you do not pass, you can reschedule, but you must wait 24 hours before booking the retake. Let's recap the test day numbers. The state life exam is 31 scored questions in 50 minutes. You pass with a 70. Each exam fee is $92, including the $50 state charge. The resident license fee is $215 for 2 years. You schedule 24 hours ahead, cancel 48 hours ahead, and arrive 30 minutes early with 2 matching IDs. That is the Illinois layer. Let's do one last sweep of the numbers that matter most, because if you carry these out of this video, you are carrying the spine of the state exam. Prelicensing, 20 hours with 7.5 live. CE, 24 hours with 3 ethics. Grace period, 30 days. Free look, 10 days, or 20 on a replacement. Incontestability and suicide, 2 years each. Reinstatement, 3 years. Guaranty Association, $300,000 for life, $100,000 cash value, $250,000 annuity. And the state exam, 31 questions, 50 minutes, pass at 70. Say them out loud, write them down, quiz yourself until the 2s and 3s and the 300s and 250s stop sliding around. You came in nervous about a dense state exam, and you now have the Illinois-specific material it is built on. Study these numbers, trust your national course for the rest, and walk in knowing you have seen exactly what they are going to ask. You have got this. If this video helped you feel readier for the Illinois exam, take a second to like it and subscribe so it can reach the next person studying for the same test. Now, go pass it.